Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are responding to getting back to work following coronavirus. Now, Phil, the market was close to flat in May, and I guess everyone's question now is, will there be a June swoon amid heightened politics and protests and, of course, the race to find treatment for COVID-19?
Yeah, I think that's everybody's question, and we won't know until we see what happens. But if you look at May, there's a couple of interesting events that you can kind of draw from. During the performance of May, we had a couple of dips and we had a couple of rallies. The big dip, sort of on middle of May, was that day or two where Powell and Fauci both did speeches that gave everybody a bit of a reality check on how long vaccines were going to take and how much economic damage the unemployment could do. And the market sold off pretty aggressively. And of course, then the very next Monday, Moderna came out with a vaccine that had a promising stage 1 trial, and the market recovered all that back up. And then last week on Tuesday, we actually had a pretty good bounce after the long weekend because everybody was looking forward to the opening up of economies. So you can kind of see how the market has been flat in between, but driven by these events that highlight the success of vaccines, the success of getting economies back to work, or the lack of that. And the lack of that is something that we can only model. So we don't really know until we see what the data shows.
Yeah, we can really see that in our first chart here as we take a look at S&P futures in May. Feels like there was a lot of movement, but at the end of the day, it really was relatively flat. And I would expect that we will continue to see this choppiness kind of trade until we get visibility and clarity but beyond most of these issues.
Yeah, and obviously we're through earnings season now too. So for the next month or so, I think the markets will probably focus on, in terms of coronavirus, the vaccines and the economic recovery news. We can look at China and see how they're going because they're a month or two ahead of us. And we know that they've had a sort of jagged restart where they've had problems with supply chains and demand from other economies. We can also keep our eye on Europe, which is a couple of weeks ahead of us. Because they've opened up their economies now as well. And thankfully, so far, they don't seem to have seen a second wave of cases, which means they can start to open their economies up wider and get more people back to work, which I would also be a really good result.
Yeah, it certainly would. And I want to move on to our next chart here because what's interesting is typically we'll see markets supported by mutual fund flows, but that really wasn't the case in May.
Yeah, I mean, if you look at this chart, it goes back almost a couple of decades, and you can see typically mutual fund flows, when they're positive, the market's returns are positive. So the blue line and the red line pretty much overlap. But in the last, and it's really not since coronavirus, it's really the last couple of years, there's been a bit of a dislocation from that. So mutual funds have seen net outflows from equity markets while the markets have stayed quite strong. And just in the last month or two, that's perpetuated. So we've actually seen net outflows up until the last week or so, actually. While the equity markets have bounced quite strongly. So it raises the question, who's bought this market back up? And we've talked last week and the week before about the amount of retail trading that looks like is happening, or the new accounts that came through the earnings statements of the retail brokers, the increased level of off-exchange trading that looks like it's coming through the data series that relates to retail. So it's possible that retail are involved in buying. I mean, in reality as well, this is obviously a longer term trend out of equities, and that could be being driven by demographics as well. So as people get older, their 401k plans naturally tilt out of equities and back into bonds. And maybe that's happening at the moment faster than all of the new millennials can put their money into equities, even ETFs and mutual funds. So in reality, this might just be a more demographic shift.
All right, if we move along to our next couple of slides here, looking at the COVID-19 data, it seems to be that we're continuing to go on the decline, but the other slide shows that there's another hot spot that's emerging.
Yeah, so obviously the global new cases here is increasing again, which at first sight doesn't look like good news, and it's not good news, but there's a subtlety to where the cases are coming from. You can look at the US, it's obviously not coming from us, although we have not tackled the curve nearly as well as a lot of the European countries, and I put Italy in here just because it was one of the first hotspots outside of Asia, where it was in the press, it had a big strain on its hospital system. They went into quarantine and they had a lot of success getting new cases down to around about a 10th of peak levels. In the US, we're still hovering about 75% of peak levels. So we don't look like we've done such a good job of containing coronavirus as other European countries. But if you do look at the new cases by region, you can kind of see the evolution of coronavirus as it's wafted around the world. So China obviously was where it started, and people living near China. We had Korea and Japan were pretty prevalent in the press with their cases, and start to take up some of the new caseload. And then we started to see it come into Europe, like we talked about with Italy and Spain as well after that. And then the UK sort of starting to take over the new caseloads from the Asian regions. It's interesting, isn't it? Because we look at America with the most, or the US with the most cases by far. And actually, the North American region throughout this time series hasn't ever really dominated the time series. So even now, where we're not even double what Europe is, despite the fact that Europe looks like it's crushed its curve a whole lot more. But to your point, what's happening now, and the reason we've had a new spike, is the South American cases. The emerging markets are all seeing cases increase. And so you can see the virus now has moved through the developed markets and it's starting to affect emerging markets.
All right, and to end on a positive note here, we're starting to see personal income rise despite spending falling, but that also means there's increased savings. So that could be good if you think about it from a longer term perspective with all of this pent up demand.
Yeah, that was one of the surprises from the data last week, was that income actually rose despite the fact that we know a lot of people are on unemployment. We know a lot of people have lost jobs or are working part-time or partial hours. And you can see in the data, it's pretty much all the stimulus checks that have made the difference. It is interesting as well with the data. It looks like most people have saved their stimulus checks, which I guess with stores closed is not such an unexpected result. And hopefully that means that when the stores do start to open, which we've talked about happening in most of America this week, New York next week, people will have all those savings ready to go spend, and we could have some pent-up spending, which would augur well for a V-shaped recovery, even though we've talked plenty of times about how looking at other countries, the V is pretty hard to achieve just because of the supply and demand chain issues that kind of filter through.
All right, Phil. Thanks for joining us as always.
You're welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.